Welcome options traders and Facebook fans, and this is a Facebook mini trading tutorial from optionsatoz.com. And in this video, I'm going to cover the concepts of risk and reward and show why so many traders struggle and lose with options. It's not because the options are necessarily risky. Instead, it's because traders have misperceptions of the risk-reward connection. To make the point, let's start with a simple question that almost all new traders, and even many experienced ones for that matter, get wrong. Which is the riskier bet? One where you could pay $99 to potentially make $1, or another where you could pay $1 to potentially make 99? Have your answer? All right, well, hold that thought for right now, and let's check that answer in just a bit. To succeed with options, you must understand how markets arrive at prices. Market traders are always pricing assets according to how much money they believe they can make from the investment and the risk or the probability for loss. These interactions create a risk-reward relationship that must always hold. The risk-reward relationship says that when risk rises, the reward rises too. And when risk falls, the reward must fall too. Notice that risk and reward are chained together. They always move in the same direction. To understand why this relationship works, let's say that I put a package in front of you which has $100 cash guaranteed inside. How much would you be willing to pay for this box of cash? Well, if you think about it, you should be willing to pay a very high price, probably close to $100, because you're guaranteed to receive $100. There's no uncertainty about how much you'll receive, so the price would be very high. So let's say that you pay $99, and in response, that means you could end up making a $1 profit. But now let's say I place two boxes in front of you, but only one has the $100 cash inside. The other is empty. How much would you be willing to pay to select one box now? Well, with two boxes, there's now uncertainty or risk as to whether you're going to receive the $100 cash. And because of this risk, the price you're willing to pay should be lower, perhaps $30. And if you're lucky enough to select the right box, that means you'll make a $70 gain. Notice that because you lowered the price, the amount you can potentially make is greater. In other words, price went down, but reward went up. Once we tie the risk concept into this, look at the connections. Risk increased, that caused you to push the price lower, and that caused the rewards to go up. Risk and reward move in the same direction, but opposite of price. All right, now let's get crazy with it. Let's say we did the same thing with 100 boxes. They're everywhere, but only one of them has the $100 cash inside. So how much would you pay to select one box right now? Well, now there's a tremendous amount of uncertainty or risk, and your price will therefore be lower, maybe just $1. But notice that the low price creates a potentially very large reward of $99 if you happen to pick the right box. So again, check out the connection once we account for risk. The risk in this case has increased. That caused you to push your price down, and in response, it leaves you with potentially a very high reward. As before, risk and reward move in the same direction, but opposite of price. Let's place all three of these scenarios side by side, and you can see what causes the risk-reward relationship a little clearer. So as we move from the single box to the double, we increased the risk, and that caused you to push your price down from, let's say, 99 to 30. But as we increased the risk even more and put even more boxes in front of you, how did you respond? You responded by pushing the price even lower. What did that do for the rewards? Well, when you went from the single box to the double, it pushed your rewards from $1 to 70. And when you went from two boxes to 100, it pushed your potential rewards from 70 to 99. However, where traders get tripped up is when they believe that a cheap option has low risk since they can only lose a small amount of money. That is incorrect thinking. Price is not risk. It's a reflection of the risk. And using this diagram, you can see that the cheap opportunity using 100 boxes isn't low risk. It's high risk, and that's why the price is low. So if these were options and you were attracted to that $1 option because you thought it was low risk, you actually stepped into the riskiest opportunity on the board. So to answer the question at the beginning of this video, if you said the opportunity to pay 99 and make 1 was high risk, you can see that that can't be true. The only reason the market would bid up a price to 99 and leave you with $1 reward is simply because there is less risk. Now, as a consequence of this risk-reward relationship, it turns out that price is the equalizer. For any financial asset, all assets are equally attractive in terms of risk. And the reason is that this seesaw between risk and reward must always remain in balance. And the way that the market does that is by adjusting price. So if we see a situation where risk increases, the market will respond by pushing price lower, and that in turn is going to push the reward higher. Notice that risk and reward again move in the same direction. But once that price is moved lower, the seesaw is back in balance, and we can say that this has been priced according to risk. The price is fair. On the other hand, if risk is pushed lower, in other words, it becomes more of a guaranteed type of a product, the market will respond by pushing the price higher, and therefore the reward will get pushed lower. So the risk and reward will end up being in balance because the market adjusted price. As before, risk and reward move in the same direction. Financial markets work the same way. Financial assets, including options, are like packages of hidden cash. Nobody's really sure how much they'll be worth, but traders are making educated guesses. The more potential the cash, or the higher probability for receiving it, the higher the price. The less potential for cash, or the higher the risk, the lower the price. So in an active market, we have lots and lots of traders absorbing all of the information flowing through the markets, and they're making decisions on how much to bid or offer on various options. And traders will compete by placing bids to buy and offers to sell. If there's an equal number of buyers and sellers, the price will be stabilized. You won't see it move. For example, we might see a $100 call trading for $3. But if news comes out making traders believe that the option might capture more profits, that's like saying there's more potential cash inside the package, and you'll have more traders lining up to buy. And in response, the price must rise. So let's say it pushes our $100 call up to $4. So how does the market get back into balance? Well, as the price rises, it attracts sellers. Sellers like high prices, and they respond by coming to the market. And eventually a number of sellers comes in to balance out those more buyers over there on the left, and the price will stabilize. Now let's take a look at the opposite and say that some negative news comes out and making traders believe that the option might capture fewer dollars. We have less potential cash in that package. And what's going to happen is you'll see more people lining up on the sell side. And in response, the price will fall, and let's say back to $3. So it's going to bring this market back into equilibrium. Well, as price falls, it attracts buyers. Buyers like low prices. And when prices are low, you're going to see a lot more buyers flooding the markets, and eventually we have a buyer for every seller, and our market is again stabilized at a lower price. The key to understand for successful options trading is to realize that cheap options are not low risk, even though it's true that you can only lose a small amount. The low price is a result of the high risk. So here are some option quotes on Apple Computer with 88 days till expiration. Most new traders would believe that this 180 call down here, priced at $1.36, is low risk since you can only lose $1.36. But now you know that that is a reflection of the high risk. And that's easy to see once you consider the break-even point, which is the 180 strike plus the $1.36 price, or 181.36. And that means that Apple stock must rise to 181.36 at expiration just for you to break even. And with the current stock price just above 157, there's a slim chance of that happening in 88 days. The 180 strike is a high-risk option, even though it appears to be low risk. However, take a look at the 135 call here at the top, which is priced at $24.10. The break-even point is the 135 strike, plus the 24.10 price, or 159.10. And that means the stock only needs to rise $1.89 by expiration before you begin making money. There's a much higher chance for the stock to be 159.10 rather than 181.36. And that's why the 135 call is lower risk and why the price has been pushed higher. Just remember that price is a reflection of the risk, and you'll be on your way to more successful options trading. In fact, if you take a look at this quote board, notice that as you move from the low strikes here at the top towards the higher strikes at the bottom, prices successfully decrease. That is not a fluke. That is a reflection of the risk as we increase the strikes. That's also some important option pricing principles going on there, but we'll save that for a future video. Just remember that price is not risk. Risk is defined as the probability for loss. Price is a reflection of the risk, but it is not the way you want to see risk. A low-priced option does not mean low risk. Instead, it is a reflection of the high risk. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course at optionsato z.com.